It does not work. Now either I've gone bankrupt in the last 45 seconds, or something bigger just happened.
Good morning. The banks just stopped working.
Is your card working?
Mine too.
And you can feel it, can't you? That tiny shift in the room. That little ripple of uncertainty. Because here's the truth. Now, before you panic, before you start Googling how to buy gold bars at 8 a.m., before you dig a hole in your backyard like a medieval peasant hiding treasure from Vikings, relax. Take a breath. No meteors. No zombies. No dramatic soundtrack. Just a system glitch. Or maybe not a glitch. Maybe something bigger. Let me tell you something carefully. I've watched the world move from paper ledgers to glowing screens. I've seen people stand in lines outside banks, and I've seen people trust invisible numbers floating in the cloud. So when someone asks me, what would happen if banks stopped working tomorrow? I don't treat it like fiction. I imagine the silence. No transfers. No card payments. No online banking. No ATM withdrawals. Just numbers frozen behind glass. And before you jump to dramatic conclusions, listen to the whole story. Because what breaks first might surprise you, and what survives might surprise you even more. The first 24 hours would not feel like collapse. They would feel like denial. At 7 a.m., someone refreshes their banking app. It doesn't load. Server maintenance, they think. At 8 a.m., social media begins whispering. At 9 a.m., news channels interrupt regular programming. By noon, the realization spreads. This isn't a small outage. The entire banking system has stopped functioning. But here is what most people misunderstand. Modern economies do not freeze instantly. Grocery stores already have inventory. Gas stations already have fuel in underground tanks. Delivery trucks are already on the road. Electricity grids operate separately from retail banking networks. The machinery of society continues moving for a while, like a train coasting after the engine fails. What changes first is behavior. People try their cards, declined. They try another card, declined. They try to withdraw cash, ATM unavailable. A few stores switch to cash only. Lines form quietly at first, then visibly. Not chaos, not yet, just tension. And tension spreads faster than information. Employers begin asking, how do we run payroll if transfers are frozen? Landlords ask, what happens to rent? Stock markets, if open, drop sharply on uncertainty alone. Because markets don't fear events. They fear not knowing. By evening, the tone shifts from inconvenience to concern. The first day ends not with riots, but with millions of people lying awake, staring at the ceiling, asking the same question. If my money exists, but I cannot reach it, do I truly have it? On day 1, cash becomes king. On day 2, cash becomes scarce. Here is the uncomfortable truth. Most modern economies do not keep enough physical currency in circulation to satisfy a population trying to withdraw everything at once. The majority of money exists digitally, entries in databases, promises between institutions. ATMs would empty quickly. Banks, if closed, could not replenish them. Even if vaults contain cash, distribution requires functioning systems and coordination. And something subtle happens. People begin hoarding, not because they need 10 times more food, but because uncertainty multiplies demand. A person who normally buys groceries for 3 days suddenly buys for 2 weeks. Multiply that by millions. Small businesses feel pressure immediately. A cafe depends on daily cash flow. Suppliers depend on predictable payments. Contractors depend on invoice settlements. When the payment chain stalls, stress travels backward through the economy. Money is not valuable because it exists. It is valuable because it moves. When movement stops, liquidity becomes the central problem, not wealth. You might have savings. You might have investments. But if they are trapped in a frozen system, they are temporarily theoretical. This is when barter conversations begin. Informal arrangements, delayed payments, IOUs between trusted partners. And here is something people forget. Economies operated for centuries without digital infrastructure. Humans adapt surprisingly fast when systems falter. But adaptation requires trust. Without trust, even cash becomes fragile. By the second or third day, governments would act decisively. Emergency sessions, central bank statements, coordinated press conferences, assurances that deposits are guaranteed. Deposit insurance mechanisms exist for precisely this reason, to prevent bank runs from becoming self-fulfilling disasters. Central banks might inject emergency liquidity into critical institutions. Temporary capital controls could be imposed. Withdrawal limits could be set. Payment moratoriums might be declared. Would this calm everyone? No. But financial systems are built with crisis protocols. The people at the top of central banks spend years modeling worst-case scenarios. They understand that confidence is more important than perfection. Because if citizens believe their savings are permanently gone, panic becomes uncontrollable. Governments would prioritize restoring basic payment infrastructure, protecting small depositors, stabilizing interbank settlements, preventing systemic defaults. International coordination would likely follow. Modern finance is globally interconnected. A failure in one major economy ripples through others instantly. This is not 1929. Systems today are more complex but also more monitored. The real question is not whether governments would respond. The question is whether the public would believe them. And belief is fragile. You might assume supply chains would collapse first. In reality, psychology collapses first. When people lose confidence in payment systems, they change behavior in ways that create secondary stress. Companies delay investments. Consumers postpone large purchases. Businesses hold onto inventory instead of selling at normal volume. Credit freezes. The modern economy runs on short-term trust agreements layered like glass panels. Company A extends 30-day credit to Company B. Company B extends 60-day credit to Company C. These chains operate quietly, invisibly. If banks freeze, intercompany settlement slows. That's where cracks form, not on supermarket shelves, in spreadsheets. And here's a truth that experience has taught me. Crises accelerate weaknesses that already exist. Highly leveraged companies feel pressure immediately. Households living paycheck to paycheck feel it next. Financial institutions with thin buffers begin to wobble. The system does not shatter all at once. It fractures along existing stress lines. Rumors amplify everything. Social media speculation spreads faster than official communication. A single viral claim can cause localized panic buying or withdrawals, even if inaccurate. In finance, perception can temporarily overpower reality. That is the most dangerous phase. Now we reach the question that keeps people awake. Will your money disappear? If the cause is a technical failure, cyber attack, infrastructure malfunction, balances are almost certainly recoverable. Banking systems use redundancy, backups, mirrored data centers. Your numbers are stored in multiple locations. If the cause is systemic insolvency, meaning banks genuinely lack sufficient assets to cover liabilities, then outcomes become political as much as financial. Governments may recapitalize banks. They may nationalize institutions. They may restructure deposits above certain limits. Most developed countries insure deposits up to defined thresholds. That insurance is designed to protect the majority of citizens. But here is the uncomfortable nuance. Money in a bank is not a physical object reserved for you. It is a liability of the institution, a promise to pay. Most days, that promise is solid. In crises, promises are tested. Your funds might not vanish, but access could be limited temporarily. Withdrawal caps could be imposed to prevent systemic collapse. Currency values could shift if markets lose confidence. There is a difference between nominal loss and real loss. If inflation spikes due to crisis response, your balance may remain numerically intact, but its purchasing power declines. That is a quieter form of erosion, and often more damaging. At this point, someone inevitably asks, what about decentralized digital assets? If traditional commercial banks stop functioning but electricity and internet infrastructure remain intact, decentralized blockchain networks could continue operating. Peer-to-peer transfers do not rely on bank intermediaries in the same way. However, crises affect sentiment across all asset classes. Cryptocurrency markets are historically volatile even in stable conditions. In systemic banking stress, volatility would likely increase dramatically. Some investors would view crypto as an alternative store of value. Others would liquidate holdings to secure liquidity elsewhere. Liquidity preference dominates during crises. Digital assets provide diversification, not immunity. And if the crisis affects energy grids or telecommunications infrastructure, even decentralized networks face operational constraints. Technology changes the shape of finance. It does not eliminate risk. So what is the real lesson in imagining banks stopping tomorrow? It is not paranoia. It is preparedness. Healthy individuals diversify, not only investments but access methods. Some liquidity, some resilience, some redundancy. Emergency funds exist for uncertainty. Diversified holdings reduce concentration risk. Understanding how deposit insurance works removes unnecessary fear. But the most important asset in any financial disruption is composure. History shows that systems rarely collapse overnight without warning. They strain, they signal, they adjust. The world economy has survived wars, depressions, hyperinflation episodes, sovereign defaults, technological crashes. Human coordination, though imperfect, is powerful. The financial system is fragile in moments but adaptive over time. And individuals who remain rational during turbulence consistently fare better than those driven by panic. The greatest currency during instability is not gold. It is discipline. So if banks stopped working tomorrow, would the world end? No. Would it shake? Absolutely. For days, maybe weeks, life would feel uncertain. Payment systems would strain. Governments would intervene. Markets would convulse. Confidence would be tested. But society would not vanish overnight. We built these systems. We maintain them. And when they fail, we rebuild. The wiser question is not, will everything collapse? The wiser question is, are you prepared financially and psychologically to navigate disruption without losing clarity? Think about it carefully. And if this reflection gave you a deeper understanding of how modern finance truly functions, then don't just move on. Share the conversation. Because awareness spreads stability, and stability in uncertain times is priceless.